This video deals with the importation of goods into South Africa. People really struggle with this because this is when you're buying and you need to pay output VAT across to SARS. So let me explain the concept with it. So let's have a look in this top block here for conceptual understanding. It says, consider a person standing on the border of Botswana and South Africa. You want a chocolate bar. Cost 10 Rand in Botswana and 10 Rand plus 1 Rand 50 VAT in South Africa. People would buy from Botswana, it's cheaper. Okay, now just conceptually, imagine you went and bought it in Botswana and you wandered across the border with this bar one chocolate. Technically speaking, you would need to pay VAT to SARS when you brought it across the border. So when you import, there is an output VAT paid at the border post. And then if you were to use that bar one in your business, you'd be able to claim the input VAT back across. So you technically need to levy 1 Rand 50 output VAT, pay it to the customs official at the border, and that would be output VAT. And the government actually charges you output VAT when you import goods into South Africa. Okay. Now, conceptually, how much are we going to charge? Now, if you're a student that's allowed to take a cycle legislation handbook into an exam, these are the sections you should be taking. So, section 7.1b, import goods, output charge, that's in that section. So this is why we charge output VAT. The input VAT claim, when you take that good and use it in the business, if you put that bar one into your business, that's section 1, definition of input VAT, paragraph A2, sorry. Okay, 13.2ab, how much do we value the goods at? You value the goods plus the duty levied, increased by a factor of 10%. If it's something that comes from Botswana, Swaziland, Lesotho, or Namibia, you don't increase it by that factor. So basically the 10% doesn't apply if it comes from Botswana, Swaziland, Lesotho, Namibia. Okay, and the timing of it, it's when goods which entered for home consumption in terms of the Customs and Excise Act shall be deemed to be imported on the date when they so entered. So technically these are the things that I would highlight inside your cycle legislation handbook. These are the tags that I would put in just to tell you where everything is, and I would bundle these tags together so that if you ever got an import question, you know what to do. So going back, what's going to end up happening? Imports from BSLN countries, Botswana, Swaziland, Lesotho, Namibia. Value of supply, output VAT is charged at 15% of the customs duty value. If it's not from Botswana, Swaziland, Lesotho, Namibia, can you see it says from non-BSLN countries? What did the section say? It's customs duty value plus 10% of customs duty value plus any non-rebated customs duty or import surcharges gives you an amount times 15%, and that'll give you the value-added tax. And the time of supply, when the goods are released in terms of the Customs and Excise Act. Let's do an example of each. It says goods with a customs duty value of 100 were imported from Namibia. So what's going to happen? It's customs duty value times by 15%. So what's output VAT? 15% times 100,000, 15,000 collected at the point of entry. It says goods with a customs duty value of 200 were imported from Brazil. Customs duty and import surcharges of 40 were charged at the point of entry. So what's going to happen? Output VAT is how much? 200 plus 10% of the customs duty value, 10% of 200, plus any of those imported surcharges and customs duty, 40,000 Rand given inside the question, times 15% gives you 39,000. Please just remember it's 15%, not 15 over 115. We only use 15 over 115 when the amount includes VAT already. This can't include VAT because there's no SA VAT included on a good that's been brought to the border. Just one or two things with timing. There's a concept called a bonded warehouse. You guys can read through what's there in purple. But basically what happens with the bonded warehouse is if you don't want to pay the customs duty and the import duty now, you can put it into a bonded warehouse, usually for a period of up to 2 years, and you'll only pay the import duty and the customs duty when it's taken out of that bonded warehouse. Please note that you run a risk in that if it stays in that bonded warehouse longer, what's going to happen is that the customs duty could increase on the goods, and you'll end up paying more. The other thing is if they do take away customs duties, you're required to actually pay the customs duties there and then. So you can't avoid customs duties by putting it into a bonded warehouse. You're always going to pay that minimum amount when you put it into the warehouse itself. The other reason for bonded warehouse is if the goods is not for South Africa. You bring it to Durban Harbour, but you're going to take it somewhere else, and it's not going to be used in South Africa. You can avoid import duties and customs duties if it's never brought into South Africa, and you can also avoid the VAT. Let's look at the 3 practice examples now. So you should probably pause your video now and actually try the question and then come back to this and try do the question. Please press pause now. Okay, so I'm assuming that you've done it. It says Star Limited is an SA company that's registered as a VAT vendor. Preparation of last month's VAT return. It says goods were imported by a VAT vendor and output VAT of 10,000 is charged at the point of entry. The vendor paid 10,000 output, clearing customs in the last VAT period. These goods have been brought into use in the organization. The company imported the following shipments of goods. So let's just do this. If I paid output of 10,000 this month, I can now claim a 10,000 Rand input this month. So as long as I bring the goods and use them inside the business itself, I will be able to claim that VAT back. If you brought it in and you didn't use the goods within your organization, then what's going to happen? You're going to not be allowed to claim the input VAT. So shipment 1. So shipment 1 is from the United States. Customs duty value is 500,000. Customs duty and import surcharges are 60. Calculate output VAT. So what's the rule if it comes from the United States? It's a non-beer selling country, so it's customs duty value plus 10% of customs duty value plus any customs duties and import surcharges times 15%. So let's go back and let's do it in this question. What's going to end up happening? So it's going to be 500,000 plus 10% of the 500 plus the import surcharge is 60,000. That's going to give you a sum total of 610,000 times 15%. What would that be? 610,000 times 0.15. That would give you 91,500 rands worth of output VAT. That would need to be paid at the border. So shipment 2 is from Namibia. Customs duty value is 200,000. Calculate output VAT. So this is 200,000. Do we add 10%? Absolutely not. It comes from a BSLN country, Botswana, Swaziland, Lesotho, Namibia. We don't need to add it on. So plus 0. So we're inside this question. We added 10%. This one we don't. There are no import surcharges mentioned in the question. Leaves you with 200,000 times 15%. Leaves you with 30,000 that you would actually claim. Practice example 13.2 now. What happens when it's in a foreign currency? So it says goods are imported from the United States by Moon Limited. The cost of goods is $20,000 and are placed on the ship FOB when the exchange rate was $1 equals 8 Rand. The goods reach customs when the exchange rate is $1 equals 9 Rand. The import surcharges are 2,000. What amount will be accounted for? It's United States, therefore we are going to say $20,000. How much were they worth when they reached South Africa? 180,000 using the 9 Rand. And they're brought into customs duty. Customs for what is then going to happen? We're going to add 10% onto that, another 18,000 Rand. Plus, all the import surcharge is 2,000, will give us 200,000 Rand. Times 15% is going to give you 30,000 Rand. Okay. Now remember with the bonded warehouse, we only pay when we take it out. So this question says, Sun Limited is a South African company that's a registered VAT vendor. Shipment 3 was imported 6 months ago and was placed in a bonded warehouse. Had the goods been taken then, import surcharges of 20 were payable. Whilst in the bonded warehouse, import surcharges increased to 50,000. The customs duty value on the goods imported from Sweden was 300,000. The goods were removed from the bonded warehouse and import surcharges of 50 were paid. What amount of output VAT will be accounted for? So customs duty value, 300,000, plus 10%, because it comes from Sweden. It's not a BSLN country, not Botswana, Swaziland, Lesotho, or Namibia. We use the 20 or the 50. We have to use the 50. Yes? And what's going to end up happening? We need to work out the amount of VAT on that. 380,000 Rand times by 15% gives you 57,000 Rand. So the amount of VAT on that would be 57,000. Now note, if customs duties had been taken away, you would still have to pay 20,000 customs import surcharges when you took it out of the warehouse. It's only works to SARS's advantage. You can't, if you think that SARS is actually going to remove import surcharges and customs duties, you put it into a bonded warehouse, it is not going to benefit you. So those are the 3 examples.